watching Monty TV. I'm Jackie Karsh, sitting down now with Alexander Lux. He's the Managing Director for DC Advisory.
Hi, Jackie.
Thanks so much for sitting down with me.
Pleasure.
What is the view of tech and software investors currently?
So the talk is very much at the conference about the recent sell-off in software and tech stocks. So what you have is the NASDAQ was trading about 16,000 at the start of the year. It's now about 11,000. So that's a massive drop. Why? Because the inflationary environment is putting pressure on interest rates. And when interest rates go up, those businesses that are valued on future earnings get the most of a hit. And that's exactly why software and tech business, where most of the values in the future have taken the hit. And so the question very much is, has the market bottomed out? And what does that mean for software and tech businesses which are not public? How should they think about scenario planning about the future?
So what should investors be doing then?
So I think the question is more about what should companies do. And I would say, John Chambers gave a very interesting discussion yesterday where he said, look, scenario planning. Think about scenario A, B, and C. What is the worst case that can happen? Be prepared and understand what that means for your cash flow profile and your financing requirements. And understand and accept that it may take 24 to 36 months before you can get your next financing round on. Be prepared. That is the key message being given at the conference.
Investors typically, especially when it comes to tech companies, ignore losses.
Yeah.
But should they still be doing that in this market?
So that's a very good question. Right now, you're rightly so observing that the focus is on profitable growth. You hear this constantly. Profitable growth, demonstrate a path to profitability. That has always been important, but right now it's even more important. Investors will still invest in businesses that are loss-making, but you have to prove that your unit economics are great and that you get to a path of profitability. But the third thing that is very important is that you don't talk to investors like, I need to raise $20 or $30 million and I'm just going to splash it out. No, you can invest it, and if you see it's not working, you can pull back. That responsible spend of the money raised is going to be very important.
After we separate the men from the boys, will we be left with really strong companies that will still be performing at levels before the pandemic or before the supply chain issues?
Yes, I think that's absolutely right. And you actually mentioned a very good point about COVID. So when it happened about 2 years ago, there was uncertainty. But when you speak to people today, what we're seeing now with the sell-off of the software and tech market, the inflationary pressure, the macroeconomic uncertainty, this is completely different than what we saw during COVID. That was a temporary blip. However, bad the COVID situation was, but right now it's a different environment. The message is very clearly for businesses, plan for an outcome that may be quite challenging for 24 months to come, but the good companies will inevitably come out of it stronger, better, and potentially having acquired some of the struggling businesses.
Do you think we'll see more M&A, or will that also slow down?
It's very likely we'll see more M&A, but of strong businesses acquiring struggling businesses. Because inevitably, for certain businesses and situations, the multiples will come down, and that creates a buying opportunity. So I think it would be wrong to say that in software and tech, M&A volumes will come down a lot, but there will be inevitably a slowdown, which we've seen in the last 2 quarters already.